Welcome to Market Buzz. I'm Greg Schnell, the Canadian technician and host of the Market Buzz. Each show we do a deep dive into different industries using weekly charts to see what is happening on a long timeline. Please follow me on Twitter at Schnell Investor, and you can also find my blogs on ospreystrategic.org as well as StockCharts.com. So lots to talk about. I'm wrapping up the year with a year-end review part 2. So the first one was focused on the consumer. Second one is focused on industry. So we're not really looking back, we're looking forward, but obviously we'll use charts to help us. Okay, so I want to show you some of the economic indicators for the business cycle, some of the currency signals and commodity signals that we're seeing out there. And I think it's really, really important for us to pay attention to both of these areas of the market. I think if the US dollar goes higher again, and I think commodities, we have two issues. One, if commodities are in demand, we have too much inflation, which puts pressure on the Fed. And if we don't have demand for commodities, then we've got what the Fed probably wants, but we probably don't want it for the economy. So, tight balancing act. If you've never checked out our website, it's called ospreystrategic.org. You can head over there and check out a membership at any time. Try 1 month at just $7, see everything we've ever done, go back and look at all of the data. You can check out the Schnell strength indexes, where they're currently at, all that kind of good stuff. So let me jump in here. I've got a lot of tabs to go through up here at the top because I want to hit this off pretty quickly. But again, the big issue facing us right now is the Fed is raising rates at a rate that we haven't seen before. So at the bottom is the rate of change indicator. And typically over a 1-year period, 12-month rate of change, we would experience something in the order of a 1 or a 200% increase. So maybe a doubling within a year. We started in February at 0.15 going up, and now we're well over 4.25. This chart hasn't updated yet, but we're soaring. And so the problem is this rate of change is now almost 5,000%. Even if we just started at a 1% level, we're still over 4.5%. That extreme move is something we've never seen before. So it's double as fast as we've ever seen. And you can see that the bump in 04 and the bump in 2015-16 caused a bit of problems for the world if you go back and look at the charts. But my main focus here is that from 2010 to 2018, after the great financial crisis, we ended up moving. The momentum was slowly picking up again. The Fed really didn't do anything all through the first few years. Then at the end started to ramp it up. And again, as they started to ramp it up, you might remember if you go look at the charts for 2015, 2016, we ended up having a commodity lull. Then we had the run up into the tariff tantrum of 2018. So all of this momentum change, for me, what I notice on this is that the cycles are getting wider and wider. And on each one of these, it's getting harder. But the problem here is the sudden rate of change. And you'll notice we did this sudden rate of change back in 04 to 06. And it took a little while, but the economy rolled over into a housing market top. I covered that off on the part 1. So looking now on, again, I'm going to try and show different charts than I showed on the first one. So I'm not trying to duplicate everything. But here we are with the consumer price index. And you can see this is the Fed's problem, is wage and clerical workers soared here from, I'll just call it a relatively normal rate of change to an abnormal rate of change where we surged meaningfully. So what we did in 5 years, we doubled that rate of change inside 1 or 2 years. So really quick rate of change. And of course, you'll hear unions getting 6% all the time. Now and again, that does not fit with the Fed's 2% mandate, so that's a real problem. So what we're watching for is this to change meaningfully and get back on trend. Now, for it to get back on trend, it's going to be very problematic for the Fed because as they try to push this down, that obviously dampens the economy. So the next thing I want to show you is the industrial manufacturing. And this is still going up, and that's the good news. I would just say it ticked down in November, but no big deal. If we actually start to experience a rollover, that would be a problem. And I can unwind this tape here. Let's just stop. This is roughly 2000. But what you see is when this rolls over, this is an important place to watch. We have not rolled over yet. So from an industrial manufacturing, we still are trending higher. From a labor growth, we're still trending higher. And from wages, we're still trending higher. So all of those are working against the Fed right now. However, when we get into the leading economic indicators, the trajectory of the U.S. leading economic indicator continues to signal a recession. And we broke down below this minus 0.5% level, or sorry, minus 5% level in November, and pretty much assuring ourselves of a recession. Now, again, the Fed is trying to slow the economy on purpose, so this is not a surprise. But the bigger issue is the rate of change. To me, that's the big problem. When we go look at the Purchasing Managers Index, so this is purchasing managers looking forward, telling what they've done and then their expectations for the next quarter. Here you are, manufacturing output. The world is starting to go below this 50% level. So this is pretty worrying, and emerging markets are still holding up. They've actually gone sideways. When we look at the orders to inventory ratio, so again, if you have more orders than inventory, that's bullish. We don't have that right now. We have both the world and China falling below the 50% level, or the order to inventory ratio of 1. So in other words, we have more orders than inventory. Looking at new export orders, both of these are negative, the global commodity demand tracker and export orders. So I don't have anything really positive on these three charts to tell us that things have started to improve. When we look at the Empire State Manufacturing, again, these are just different ways to look at it, and you can rewind the tape if you want to get more data. But the seasonal business conditions are now falling below this zero level. And of course, we saw this in 08, 09, and we saw this in 2020. We've been down here pretty much all of 2022, and most people would say, well, no big deal. We did that in 2016. The difference was we had the support of the Fed in here, and we don't have the support of the Fed this time. So this is a chart that you can go get at the New York Fed, but the big thing for me is most of the current indicators are pointing down, and if you ask for the future indicators, of course, most people are trying to be more optimistic. So most of the future ones are ticked up, even though they haven't seen it in the economy yet. So business conditions, new orders, shipments, unfilled orders, delivery time has gotten back to normal, so that's good. Inventory levels, I would just say, are high, but still, if anything, they've started to drop a little bit. When you look at prices paid, coming off the highs, but still relatively high to history. Prices received coming off the high, same thing, still a little bit higher. Employees still ticking up, and average employee work week starting to tick down. This is one of the few changes we've seen that would actually help the Fed's case. And again, if I get into the forward-looking indicators, I don't want to dismiss them. I'm just saying it's an expectations for 6 months out. And everybody's trying to be optimistic that this will all be fixed. So I showed this briefly in the part 1, but what we're looking at are our top global risks, and we're finding financing conditions are a problem, worsening borrowers' debt capacity, and this is really consumer. But when we go down into these other ones, slumps in the large economies deepen the slowdown, our risks are high, input inflation is high, and political tensions are a problem. So all of these three are high, but the business ones are unchanged so far. So now I want to get into what I think is one of the more important areas of the market. This is oil. And we could debate what the trajectory is for oil. I think this is the inventory trajectory globally, and this is onshore and floating storage in millions of barrels. And what we see is that this continues to fall. OPEC has warned that they can't make up production. Countries like Canada and the US are trying to limit oil drilling. And the more we do this, we're seeing more coal plants turn on in the rest of the world. So the UK has turned on coal. China, Japan, India, Germany have all turned on coal to help supplement the shortage they're getting from oil. So this huge issue, this demand surplus or deficit, what we see here, this is the 2017 to 2019 average, and of course COVID screwed everything up. So we're just taking a period of time from before. Here we are 3 years later, and we have a lot less oil in inventory. Now, if we slow demand, then we have enough oil. The problem is if we don't slow demand, we're going to be in a crunch where obviously the oil prices start to take off. So that's one of the big issues for me. And again, this inventory isn't a problem until it is, like we saw in Europe for natural gas. All of a sudden, natural gas went through the roof. The windmills stopped spinning for a few days, and the power prices literally went ballistic. Most of us are too young to remember the 70s when we had the car lineups at the fuel pumps because we didn't have enough product. As we sit here and go through all of these weather-related storms in Canada, we had a snowstorm that stalled trains, planes, and automobiles. And with that, there was problems where it was so cold that you plug in a car to charge and it wouldn't charge. So at least with liquid fuel, you could get around. But again, the governments are trying to move people away from liquid fuels. So we continue to create this pressure point where we want people to move to electricity, yet electricity doesn't quite work, especially in the Canadian climate, but in northern U.S. climate as well. You have these big temperature drops like we experienced in December, and that creates a huge issue if we're going to move to a fuel source that doesn't work. And one of the things that happened with natural gas was the temperature caused a problem. So the orifice that the natural gas would flow through started to choke off due to icing. And so when that choked off, it wouldn't flow either. So the only thing that really worked was gasoline and diesel. And the oil refineries actually adapt the amount of wax in the fuel to try and prevent waxing in the winter. So we have lots of issues here, but the big issue is if the price of oil starts to take off to the upside, do we have anything to stop it? And my concern would be no. So here's the chart of West Texas crude, and you can see this is what I would call a sudden move up. And then we chopped around and made our second high, and then we had this relatively controlled move back down. But if you were to go look at a textbook of what we call impulsive waves and corrective waves, this is impulsive when it's smooth to the upside, and this is corrective when it's choppy to the downside. If we inverse those where it's choppy to the upside, like it was here, that's when we start to see it reverse. And so what we're wondering about now is, can oil break out? And my charts are telling me literally the last week here, so heading into the new year, oil is just starting to break out. And you can see here on this chart, it's just starting to move above the 20-day moving average. That's been a nice place to be on board. When it's typically stuck below the 20-day moving average, that's a problem. Now, nobody said it had to be easy, but we have lots of violations of the 20-day where it turns around right away. So the real question is the economy improving and the demand for oil starting to tighten up? And with China opening for 2023, will we see oil demand increase? And most people in the industry believe yes. So here's a quick way that I look at it, and I really just try to keep a simple table here with oil, the bullish percent index for energy stocks, XLE, XOP, and OIH. So this is the the energy spider ETF. This is the exploration and production for oil ETF, and this is the oil services When they're all above the 20-day, that's a really nice place to be on board. Exploration and production ETF did not quite move above before Christmas. And so what we'll watch for here is as this starts to pop, this looks like a really nice entry to me. And again, this would have got you out in June and kept you out for most of it. In the middle here, there was some 6-week periods that went on an okay run, but crude never really did get on your side here. So what we want to watch for, obviously, is all of this starts to turn up. Now, OPEC has warned repeatedly that there is not enough energy if all of a sudden things start to normalize. So if the price of oil starts to surge, that's going to put more pressure on the Fed. So this is a pretty simple little chart I got from Teck Resources. They're based here in Calgary. And what we see for Teck is when you look at what they provide, and they're essentially industrial metal supplier. And the problem we have is here's a 13 megawatt offshore wind turbine and how much material it requires to build. And so the issue would be for each one of these megawatts of installed wind turbine capacity. Now we've got solar as well as an example. But I just want to say how much power is 1 megawatt? Well, 1 megawatt is what the new Tesla electric semi-truck wants for a charge every day. So in a solar field, that's 15 acres of solar. In a wind farm here, this one has a 13 megawatt wind farm. You're going through massive amounts of all of this non-renewable stuff to get to renewable energy. I would just say that the demand cycle for this is huge. And if we look, this is Teck's just kind of where they think the commodities are. And what they show here is in 2024, we expect copper to peak out, and then we're actually going to go through this supply gap. And the reason they can predict this is it takes a long time to build a copper mine and get it approved and get it all permitted and operating. And Teck would know because they've just finished a big project down in Chile that starts literally in early 2023. So these mines don't come on stream easily. It takes a long time. You have lots of forward visibility in terms of how much new supply is coming onto the world. But the problem we have here is we don't have a lot. And of course, Canada has stopped some of their mining activity. The U.S. has turned down both the Resolute mine in Arizona and another big mine, copper mine in Minnesota. So you have the governments working against what the industry needs to convert to a low carbon economy. And we're trying to work this through, but it doesn't look good if they start to approve mines. It hurts their environmental view. And again, every politician in the world wants to be environmentally friendly. The real problem is in order to get to where we want to go, we need to do all this mining. Okay, what is steelmaking coal? Steelmaking coal is what's called metallurgical coal, and it burns way hotter, has more BTUs per ton. So what we see in the world is in order to get this steelmaking coal, it's hard to kind of continually mine for it. Teck Resources, it was a few years ago, mentioned that for their first mine, they did a 90-page permit application. The recent mine was 90,000 pages or something, and it got turned down before they even opened the first page. So we're sitting here where nobody wants any of this to be produced, but yet to get to where we want to go with, I'll call it renewable energy with non-renewable materials capturing that energy, we're stuck here. So we're about to experience this ramp up in prices, and that's what we're going to cover off right now. So let me just shrink this back down. And then when I look at the scope, this is basically Teck Resources, a page from their, this is from the the Federal Reserve, and this is their Fred report. But what we see here, January, these prices for copper, nickel, lead, and zinc, literally Teck Resources world, have been trending up. They had a brief pullback here, and now they've started to turn back up. Now, the question is, are we going to slow global demand enough? And if that pulls back, that's a problem. So when we quickly look at commodities, and I'm just going to show you the charts. In general, these first two are agricultural related, but you can just see sloping down, starting to turn up here on soybean. Sugar broke out to new highs to end the year. Cocoa's starting to fire up. Livestock is still continuing to trend higher. Coffee had a big pullback, and lumber has been hit by the change from the interest rates has hurt lumber for home building, but also lumber is just getting back to where it used to be back in 2018. So natural gas, even though we're sitting in the middle of a deep freeze, they think there's enough inventory in Europe now to get through the winter. And so this is starting to break down. So is this going to continue to go down? And natural gas is what we call the widowmaker trade. And you can just see these huge spikes on here. Very difficult to trade. Crude oil still trending down. I think I showed it earlier that it looks like it's ready to start turning up. And we'll just have to see if that happens or if we're actually going to go into a global recession, which is what oil's pricing in. And then the economy slows too much. Gasoline started to perk up this week. Heating oil for home heating oil and also diesel fuel in trucks and planes. This is starting to take off. Planes are jet B fuel, but similar. Anyway, what you see is this is starting to move higher. And as we approach this supply shortage, that's what we're worried about, is all of a sudden these charts all of a sudden start to turn up. So I would just say it's pretty important as to what their direction ultimately is, but you can see copper starting to trend higher, but still below its 200-day. Copper miners have started to push above their 200-day. Steel has been trending up, and again, if it tops out here, this is a topping structure for steel. You could have the same thing for the copper miners, and what that would mean is that the global economy is slowing and we're about to hit a brick wall, which gets me back to the original chart from the Fed. I think we're creating this. And so what I'm watching for on my charts is, does this break down or break out to the upside? If it breaks out to the upside, the Fed's got an even bigger problem trying to control inflation. And lithium has started to break down because the CTF also has some of the Tesla shares and that kind of thing. So it's been breaking. As we look across here, precious metals, again, not much different on the gold chart than the copper chart or the steel miners chart. So I want to keep in mind here, is this going to just break down and all of a sudden we just have a real economic contraction like those first few charts I showed would suggest? We have one thing left to look at and only a few minutes here. So what I want to point out is on the US dollar, a huge spike higher and a pullback. And the real question is, can it turn here? Now, you could go back and analyze this chart, but one of the things you'll notice is there's some very sharp reversals around the end of the year all the time. And on this next chart, I've actually flagged those. So I could have done 2004 as well here. But what you see is these big reversals, and it's not to the day, but it's around the end of the year. We see a lot of times here was a big pullback down, ran up into early in the year, and then literally let go for another 2 years. So is the US dollar about to fall apart, or are we about to find support at this horizontal level and bounce straight up? Now, if I add a few lines on this chart, and it's not that hard to do, just put one in there and maybe one right here. And what you see is that what was resistance becomes support. So we couldn't get through these levels, and then all of a sudden that started to become support. We've spent our time trying to bang our head on this. We finally broke out. Now, is this going to become support and we end up taking off to new highs? Great question. That's what we're trying to solve right now. And when we open this chart up a little bit more, the big thing that I want to show is that the price top here in 2000, 2002 was a very choppy affair. And then when it finally broke the big major uptrend, that was a big deal. We haven't really done that. We've broken this short uptrend. We've come back to support. And the real question is, at the end of the year, does this pivot long? When we look at charts like the euro, they're right at both downtrend resistance. They're also at horizontal support and resistance levels. So it's pretty important that we see what's going on. And we have the whole issue around Japan that could blow up, but I don't have time to cover it off today. All of this means to me that we're in a very vulnerable spot, especially based on these economic indicators at the beginning. I expect that the next few years are going to chop like this in a high inflation environment. The move off the low here to the high would have been about 70%, just to put it into perspective. So if you can miss the downtrends and enjoy the uptrends, you're going to do a lot better than somebody who tried to hold all the way through the 70s. The high inflation period. So if this is the case, I think you'll enjoy the services we offer at Osprey Strategic. I'd encourage you to head over there. But our whole goal is trying to invest when it's easy to the upside and try to miss the downside. So with that, thanks for taking the time to join me. Have a wonderful 2023. Hopefully you've learned a little bit from this video. And again, if I can do more, feel free to watch the Market Buzz all the time. I try to lay out some big picture ideas for people to try and help with their investing. And so with that, thank you. This is the end of my year-end review. Thanks, everybody. Bye-bye.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.